Innovate, accelerate, move technology forward. The startup revolution is now.
Hi, everyone. Good afternoon. I'm Greg Perez, Director at xchange. xchange is an impact first investor in early stage impact enterprises in the Philippines. And xchange and Villgro Philippines are building the Impact Pioneers Network, a first of its kind angel investor network to catalyze local capital and back high potential impact enterprises in the Philippines. This activity is made possible through the generous support of the United States Agency for International Development. And happy to be here at Philippine Startup Week 2022. Thank you all for making the time in the middle of the week to join us today for this session. So in this discussion, our guests will be sharing their insights on how innovative financing addresses gaps for the missing middle in the local startup and impact landscape. So without further ado, I'm excited to introduce to you all our speakers for today. First, we have Shuyan Tang, co-founder and CEO at the Beacon Fund, a boundary-breaking fund for female entrepreneurs in Southeast Asia's emerging markets. Hi, Shuyan. Second, we have Maui Arroyo, founder and principal at Ignite Impact Fund, the first Philippine-focused impact investment fund dedicated to investing in businesses that will eradicate extreme poverty. Hi, Maui.
Hi, Greg. Hi, everybody. Good afternoon.
Good afternoon. Joining Shuyan and Maui is Matt Viner, Director of Operations and Business Development at Emerging Markets Entrepreneurs, an early-stage venture capital firm founded in Myanmar to spur sustainable growth through mentoring and investing in startups. Hi, Matt.
Hi, Greg. Good afternoon.
Good afternoon. And last but not the least, we have my co-lead at the Impact Pioneers Network, Priya Thachadi, who is co-founder and CEO of Villgro Philippines, an early-stage impact incubator that funds, mentors, and nurtures social entrepreneurs. Hi, Priya.
Hi, Greg, and hi, everyone. Great to be here.
Hi, everyone. So glad to have you here. Been looking forward to having this conversation. And so today we'll be talking about the missing middle, but more specifically, we'll divide this discussion into three parts. First, want to dive more deeply into the missing middle. This topic has been talked about and written about a lot, but mostly in general terms, right? Like it's this monolithic problem. So want to make that a little more granular and dive into your specific local contexts. And then we want to look into the need to disrupt and diversify options for entrepreneurs when fundraising. How do we meet them where they are? And third, we present existing financing alternatives investors can consider when making offers appropriate for the venture stage. To start us off, just diving into the concept of the missing middle, what exactly is this gap and why does it exist in your local startup and impact landscape? And maybe Priya, you can start us off and then we'll go to Shuyin, Maui, and Matt.
Sure. Thanks so much, Greg. And I know I liked your context that, yes, it's been talked about a lot. I think maybe all of us have already been on many panels over the years talking about this. But I think the fact is that where we sit as Villgro at the early stage, investing space and looking at entrepreneurs in the Philippines and probably at Southeast Asia, we still see this as a gap. And maybe just to define that for us, this is mostly seen because of the fact that there are a lot of grant competitions and venture competitions, opportunities for grants, which have really increased, especially here in the Philippines, whether it's government or private funding. And then actually it's the issue because after they go to many programs, get some funding, then there is a huge leap because the next set of investors and capital really sits at the impact funds, which of course are also investing in the early stage, but are looking at certain revenue criteria, certain growth potential for growth, and very often many of the models or the risk sort of element doesn't match with what the investors at that stage are looking. So that's where from where we sit, we see a gap, and this I would say would be from about $50,000 to $250,000. Sometimes a little bit earlier as well, depending on what industry, but that's what we see mostly. And, as impact pioneers as well, like this is kind of a focus area that, like we are really diving into. But but to add, I do think that the gap is not just about the capital. It is also the fact that diverse types of entrepreneurs, and I'm sure like Shuyin can dive into this more beautifully than I can, but also the different types of entrepreneurs, I think, or the types of ventures, I think there's also a gap there, because primarily we only talk about, tech driven, very high growth enterprises, and they kind of are in the narrative or in kind of the line of sight more. But I think the reality on the ground is that there are different types of entities and ventures who are also profitable, who are also seeking capital. So there's, I would really describe it as a gap in the market and an opportunity to support these type of ventures. The issue that we see is that how do we really match kind of like the risk profile of these ventures? Because many cases, actually what they need is risk capital. And by that, I mean like capital to actually experiment and really kind of, get to the model that can really scale up. So that, of course, and sometimes grants are not enough. You actually need to find the capital that can allow you to kind of grow your market or, grow your team or invest in something that will allow you to figure out and stress test the model that can get you to the next level. And that's where, we're seeing the gap. I would say when you add sort of lenses of gender, but also urban and rural entrepreneurs, because entrepreneurial ecosystems tend to thrive in larger cities first before it kind of trickles down. And so I think, especially in the Philippines, we see that in the larger sort of ecosystems, though it's slowly changing, but maybe not changing fast enough for the number of entrepreneurs that are trying to, actually look for capital. They are being left disappointed. And probably, there's not enough education both on the entrepreneur and the investor side. Because investors feel there is an investable pipeline, and the entrepreneurs feel like, we're all here, but no one is investing in us. So there is that gap of, maybe not understanding each other as well. I hope that sets the context. I'm sure my colleagues here can, share very specific examples.
Sure. Yeah. I mean, that's, we've heard that a lot, right? Especially this conversation around patient capital and not so much around risk capital. And patient capital just assumes that you get your money back, but there's so much risk. And as you've laid it out, there's really different ways to segment the market. And you also highlighted that even that leap from that ideation stage to the point where they become investment ready for funds like us or investors like us, that also itself is another thing that I think deserves more attention. But yeah, Shuyin would love to hear your thoughts.
Yeah, thank you so much. It's a real pleasure to be here. And thanks, Priya, for giving me the perfect setup and segue into some of the points that I'd like to share. Maybe as a bit of context, so I'm based in Ho Chi Minh City, Vietnam. So I think a lot of my comments are really shaped by that experience, but do have some experience investing across Southeast Asia, including the Philippines. But will definitely not claim to be an expert. There's definitely a lot of people on this panel who know what they're talking about more than I do as far as the Philippines is concerned. So we do run a number of different funds. Some of them, you can consider them basically impact VC funds. But we also run a fund called the Beacon Fund, which you see here, which is actually a debt and mezzanine fund focused on women-led businesses across Southeast Asia. So I think, can speak from a different number of perspectives, I guess, of having run both kind of VC as well as more debt-focused vehicles. So I think Priya laid it out really, really nicely. I'm not going to try and repeat everything that she said, but I think when I came to this problem or challenge of the missing middle, at first I have to admit I thought it was more to do with the size and the stage, right? So basically, like early stage companies looking to raise less than, people debate about whether it's less than 200 or 500K, but anyway, like smaller than what most investors, impact or I guess more traditional, would be looking to invest in. And I think there's many reasons for that. I think one of the biggest challenges to share from the investor perspective is that it takes as much time and effort and energy to close a small deal as it does a larger deal, right? Yeah. So I think when it comes to the crunch, I think if investors have to prioritize and and look where to focus, I mean, it's actually quite hard to make these smaller deals work, right? So I think that was the first problem that at least I became familiar with, and frankly, I think that's still part of the gap that we see today, right? And some of the challenges that I guess we'll dive deeper into in this panel. There's some clever ways to try and tackle this one around the size, right? Around trying to really, it's always a trade-off, right? Because on the one hand, you're trying to standardize it to make it more efficient and easier to close these deals. But at the same time, a lot of these deals require a lot of nuance, right? And tailored structuring to really meet the needs of the entrepreneur. So I think that's definitely a interesting dance that we all, I'm sure, have had to do. But I think the second piece that we've also begun to narrow or hone in on more recently is around kind of the structure of the capital, right? And what types of investment instruments are being used to support entrepreneurs, because Priya began to talk about it, right? I mean, in our markets, a lot of focus on, say, tech, right? VC, private equity. I mean, these are the main. That's what, when people think about raising money, it's like VC, right? Is at least the way it is here in Vietnam. And as we all know very well, VC is not a good fit for actually quite a large number of businesses. In fact, it's only a very narrow sliver of businesses who do have, I mean, at least as VC is traditionally understood, right? And maybe we should try and be a bit more creative in how we think about VC as well. But at least the way VC is traditionally understood, you need to see a 10x type of return, right, on some of your portfolios. A lot of them fail completely, right? And it's this kind of home run, hit-driven type of model, right? But the reality is actually, and this was, I guess, a pleasant surprise to us in some ways, a lot of businesses in our company, in our countries, right, that we invest in are more, I guess, sustainable growth, moderate growth companies, which don't necessarily look towards this kind of huge growth curve and then a big exit, but actually have, sustainable growth and profitability in mind. And I think they also represent like another segment maybe of this missing middle, right? Companies which are actually quite investable. I have to say, because we always talk about, are they investment ready, et cetera. I think that's always, and there's definitely some of that, right? That challenge. But I think for the most part, these businesses actually generate cash flows and profits, right? Wow, that's actually fantastic, right? And sometimes we don't see that as much on the VC side. So these companies are actually quite investable, but we do not focus necessarily, or the way most, I guess, funds, even impact funds, are conceived of, still are pretty reliant or tend to be kind of, VCP types of structures, right, which are always looking for exits in a certain time frame, and that really limits what you can do. So that was part. Happy to share more, I think, as we get into the conversation. But what about other types of funding? Debt, very unsexy type of instrument, I have to say, in our markets. I know it has a bad rap, but actually can be a great tool. It's actually cheaper than equity, right? So starting the conversation about, how can we, bring the right flexible tools, right, which aren't just kind of VC equity style products to the market. I think that could be a big one in tackling this missing middle gap.
Absolutely, thanks. And yeah, definitely, as the enterprise grows, they really need different forms of capital. And it would be too expensive to use equity as working capital. And so that definitely plays a huge part in that. So great to see that innovation. Maui, love to hear from you. Hi.
Well, it's interesting to look at the missing middle, because on one end you have the very early stage entrepreneurs. At that point they're grant-entrepreneurs, right? They're going from one grant to another,
from one competition to another.
Yeah, one competition to another. And I have nothing against that. That's definitely a way to start. I think the way to do that, though, is to really focus on market validation, because I think the metrics there that we kind of look for at Ignite Impact Fund, if you're at the grant-entrepreneur stage, is validation velocity. Really increasing your knowledge to assumption ratio. At that point you're really learning, right? So you want to look at the speed about how you actually learn. It's the speed of learning, right? So it's not so much of like, are you breaking even? It's like really testing out the business model, and are you actually going to impact the population that you say you will? On the other side, you've got investors like us who, we have a fiduciary responsibility to our limited partners and the people who have invested in us. So, and Shuyan's right, it does take as much and sometimes more effort to close these deals as it does for the bigger ones, right? So I think you have to be quite intentional about the way you address the missing middle. And I know we're going to talk about alternative financing structures later on, but I think you have to be open to that and allocate part of your portfolio to that, because it's very easy for investors to complain that, well, I don't have deal flow, I don't have anything to invest in. You do, they're just not all that ripe yet, right? So it you have to at some point, especially in the impact ecosystem, you have to farm your own deals, um, because they're just not going to get there. It's like right before the missing middle is the valley of death. And very few people come out of that. um, so I think it's a matter of realizing that the ecosystem itself is so new. It took 40 years for microfinance to become a thing, right? It's a very new impact investing as a whole is a very new asset class. Although 68% of people who invest are making their expected financial return, and 78% all over the world are making their impact returns. So it's a very young field. So it's possible that we haven't also um, really gotten a handle about how to push people across the missing middle, right? But I think it has to be a collaborative effort between the way entrepreneurs think about their businesses and the way investors think about their funding and investment and impact strategy.
That's a great point. I think entrepreneurs always hear that, right? You're not yet ready. Where's your traction, etc., etc. But beyond that, who's helping them answer these questions? Okay, how do I get there? How do I increase, as you said, the knowledge to assumption ratio? And I don't know if a lot of them are actually intentionally running these pilots with the intention of learning more about the market, rather than focusing on breaking even and becoming cash flow positive, etc. And yeah, that's something that we've definitely seen a lot of, where there's not enough understanding of the market on the side of the entrepreneurs. Yeah, so great points. Thanks. Matt, how about from your perspective?
Wow. Well, thank you for having me here. That's quite a lot to follow. So I'm going to add as much as I can, but probably it's going to be quite limited at this point. I think that I agree with all of these main points, right? We talk about the missing middle and we talk about it fairly like it's this one thing. But the missing middle means 100 different things to 100 different types of companies. And if we only try and solve it with one solution, we're only going to serve one or two of those types of companies. And so you'll often hear that, 1 out of 100, right? 1-2% companies raise venture capital. Oftentimes that's a man, right? 9 times out of 10, it's a man. And so we need to solve this to increase that number. That's not untrue. And certainly we need to increase kind of gender parity. But I think that what's been said today, right? We need to find other mechanisms of funding, because let's say there's 100 people in that gap, maybe only 5 of them need VC. Maybe some of them need some debt, maybe some of them need some intelligent convertible notes or other structures or grants, but from a supportive perspective that doesn't build you with 16 indicators that you now have to manage alongside trying to manage your team. I've kind of been on both sides of this. Like I've had a company receiving those grants, so I understand some of the frustrations that entrepreneurs go through as well. So I think that I can't add too much. I would just say that I think we need to, and I'm excited to be having this conversation about finding different solutions, understanding that this is a very complex and multifaceted problem. And as soon as we realize that, we've got a much stronger opportunity to come up with not one, but many different solutions.
Yes, definitely. And I think those different solutions are represented here in the room, right? Multifaceted is absolutely something that we need. And well, just to follow up on that, which kind of brings us to the next part of our discussion, right? Then how do we, and you've all touched on this, but how do we then make the risk more viable? How do we close that gap? So from where you're sitting, Matt, while I have you, right? The 2%, maybe the 1 to 2%, and maybe your other ratio was 5 out of 100. How do we then close that gap, at least in the VC space? And then we'll then move to Shuyin, Maui, and then Priya.
Okay. All right. Super. I get to go first.
Yeah.
Okay. So just a bit of background here is that EME is a venture capital company in Myanmar. We started 4 years ago. We've been through quite an interesting time, as you can imagine. And we kind of came into this missing middle, right? So our ticket size is 50 to 250. We've operated in this space. And what was dynamic about the approach is that we provide a lot of post-investment support. But all of that comes after the case, right? That doesn't actually change the risk profile very much, other than you're saying, well, we can help fix things that might be wrong. With everything that has happened, we actually went back a step and created an ecosystem program to try and support founders where other kind of support had gone. And so I think that I can speak about some of this. We talked like essentially what we're trying to do is reduce the risk. And I think I can talk a bit about that. So one of the reasons that so few tickets are made is that the risk is very high. We've already talked about illiquidity and having to be very patient. The infrastructure, digital or otherwise, all of these things is much higher than in other markets. So I think the first part of the answer is like so simple, it's almost depressing and can be very gendered. And that is the one way to reduce risk at an early stage when there's little evidence is spend more time with the founders and get to know them better. The problem with this is that this almost certainly means that you've got an advantage to men, because men typically are controlling more of this money and typically will invest in people who look like them. And that means that those conversations end up being, oh, there's this guy, I really trust him, I know him very well, let's invest. Now, that is obviously wrong, but what's happening there, the phenomenon isn't wrong. The reason that they're willing to invest is that it's de-risked because someone is vouching for you. Now, these programs that can be very short term that say, we're going to help you communicate, it's not enough, right? Frankly, because you can't build a relationship in a 10-minute pitch or a couple of meetings. It takes a long time to do that. And so what we try to do is, and we'll talk about more this later, but is formalize a process where we have a longer term program, which gives investors more exposure to people at different stages so that they have an opportunity to de-risk their investment. If an early stage, if a missing middle investment from the VC perspective is all about the founder and all about, I think we talked about their speed of learning, then we need to create opportunities to increase that, but also opportunities that we get exposure to them during that journey. When we see how they respond, even with a small amount of money, how they're acting, that gives us confidence to then make that investment. So I think that one thing we can do is seek ways to increase exposure between investors and the people inside that missing middle, and make sure that it's kind of gender balanced and take extra precaution to ensure that. And beyond pitch days, right? I think, real interaction. I think beyond that, then we're looking at the really like the money side, the structuring side, the de-risking, the capital, leveraging, development, finance, and all of that side, which is probably a broader conversation. So I'll pause there. But I think trying to get exposure to the founders to reduce that risk is quite critical.
Thanks, Matt. Yep. And I think that really ties in with what Maui was saying earlier about really being intentional and not just, waiting for it to happen and, just saying, oh, I have no deal flow and come to me when you're ready, right? Shuyin, what do you think?
Yeah, happy to share. And I guess to frame it, let me say that I'm now switching gears a little bit from more the, VC hat to more the, VC startup hat to more the SME debt hat, right? And maybe I can also share a little bit about how we came to set up this debt fund, Beacon, and how in some small way we hope that it contributes to really tackling this gap at the missing middle. So I think, we saw that issue, which we've been talking about in the first part of the session, right? Around like, hey, most of the capital in our markets, it's VCPE. That doesn't necessarily work for let's say 95% of companies, right? For different or at least a large chunk of companies, right? For different reasons. And again, we're not looking at ideation startup type of companies. We're looking at SMEs, but still they're underserved. How can we serve them better, right? So that was, I guess, our problem statement or the question that we asked ourselves. And we're like, well, what are these companies like? Not one, right? So they're not necessarily looking to for an exit in many cases. These are companies that they love their business, like they love what they do, right, day to day, and it's something they want to kind of run for the rest of their lives, right, or their careers, and even passed on to the next generation, for example, right? I mean, that's just one example. But they don't see, again, this, working towards an IPO is a very specific type of path, right? That not everyone, sees as, the be all and end all of success, right, in a business. So I think that was one thing we noticed, and we're like, well, okay, that's one thing, right? So that makes equity a bit challenging, but not impossible. You can still be creative on the structuring side. But what these companies do have is some track record, and again, it's often a bit, there's ups and downs, right? But they do have some track record of delivering kind of cash flow, right, and profits, because I mean that's how they grew, right? They grew, or these are SMEs. They've been around for several years in most cases, and the way that they grew was through organic growth, right? Every year, just bit by bit, kind of adding to their business, right, and with a very kind of loyal customer base in most cases. So then, okay, we're like, well, what about debt, right? I mean, and so, but what's the landscape for that in these markets? I mean, I guess what's available is, I guess, bank financing. And I think if the Philippines is anything like Vietnam, then I think the collateral requirements would be, let's say, out of reach, right, for most entrepreneurs. And to be specific, I mean, you're basically looking at real estate, basically, or land type of collateral, right, as the only way to
basically
really
immovable assets,
immovable assets as or your car or something like this, right, as the only way to actually secure financing,
exactly.
right? And it's and that for some people that is an option, and for many it's not, right? And I think that again also contributes to this gap. And I think again there's a gender gap here, right, in terms of who actually controls some of these assets to pledge at the bank, say for a bank for a business loan. Okay, so we realized, I mean, if we want to actually meet the needs of this segment, right? So we're like, there's something interesting here, right? These are investable companies, right? So the problem is not that they they're so early stage and they have no financials or something. These are companies which have been running, right? They've got some proof, right? Some product market fit, as we like to say. But we have to be more flexible about what type of debt we're actually offering them, right? And I mean, so how does this work from the entrepreneur side? Well, firstly, on the collateral side, have to be much more, I guess, open-minded about what we accept as collateral, and looking beyond, I guess, these hard assets, right, to actually looking at the business assets, right, whether that's around receivables, whether that's around inventory, whether that's around the equipment of the business, which sounds very obvious, but as we know, right, actually the banking system is quite conservative, right, and doesn't actually look at those things as valuable collateral in most cases. I think the other piece we realized is we actually have to invest quite a bit smaller, right? I mean, these companies, they're not looking for like a $5 million loan, right? In that case, there's sources, right, available. So we have to, so at Beacon, we actually look at investments as small as 200,000. I mean, I know it's not totally solving the problem again, as we just talked about, very diverse. There's a need for, even $20,000, $50,000 types of checks, but, I think at least some way trying to push it a bit further, kind of down to the level that's needed, right? I think a third piece that we're trying to also, I guess, support the entrepreneurs with the right structures is we're actually tying the pricing of many of these loans to the impact of the company, right? So if they hit certain impact KPIs, they would actually get a lower interest rate. And again, I think that's just a very practical way to put money where our mouth is, as well as impact investors and show what we care about. Of course, I think we've talked a lot about risk. I mean, doing these types of loans, I admit it's not always that easy, right? Especially at the smaller end of the spectrum. So I think we as investors, I mean, more from the investor perspective, or with that hat on, I think we also have to be a bit smart about how do we, we are taking a risk here, right? So how do we actually get some upside, right, from these investments? So one of the things that we do is we sometimes take some warrants or options. So there is a bit of equity-like upside if a company does well, or certain, say, like investor bonuses for us, right? So even though we may not actually be equity holders, there still could be some kind of payout or bonus if a company hits certain milestones. And, again, that's always a bit of a negotiation and a dance between us and the entrepreneur. But I think, again, if we start from the fundamental of like, hey, we are taking a risk to back these entrepreneurs which are so underserved, right? Then there should also be a reward as well, right? Because I think we need to make this model sustainable and investable as well, or else I don't think we'll see the amount of capital flowing into the space that we'd like to see. So I'll leave it there.
No, that's so interesting. I mean, really, when you talk about flexibility, right? The different things that you've described, still yet have to become mainstream. And I
Mm.
guess many will be looking to beacon and learn from your experience. And I think, even if at 200 that's a great step, and maybe you kind of dip your toes in the water and until you get more comfortable with the risk at that level, until you maybe move more down to the 50,000 level. We don't know yet what the path is, but at least you're kind of blazing the trail in that direction.
Yeah, no, we try, because I think it's a combination of both, right? It's the size and the structure. So I think we had to pull that capital down to the right level. And I think, again, as we've said many times, meet the entrepreneurs where they are, right? Because there are, I think we found through this process there are investable companies here, right? We just didn't have the right tools to serve them at the beginning.
Right. Yeah. And to really start from scratch, right? To not begin with, okay, what's already available, but really, as we advise to our entrepreneurs, what does your market want? What do they need? The same way, kind of that empathy lens, right?
Mm.
And there are different ways of putting in recourse and or incentives as you've shared. So thanks for that.
Sure.
Maui, how about from where you sit? How do we make the risk more viable?
Well, I think to frame my answer a little bit about Ignite Impact Fund, we only invest in the Philippines. So it was our investment strategy is perfectly tailored to that. So we believe not just in thinking out of the box, but building a better box. As most people know, here in the Philippines, 87% of our GDP goes to 19 families. So you have a bunch of OMGs, old mainstream guys, right, who made their money in retail and real estate, but we're also seeing the largest shift from the OMGs to the COOs, child of owner, right? So the millennials, and to women, more women, right? So, and these people are looking more for and this is a trend all over the world, right? And people are looking more to make an impact, and instead of the usual model where you sort of make money and then give back. How about you invest in things that don't take away in the first place? So there's a slow trend towards that. And one of the things that I think that would make the risk, mitigate the risk and make investing in these in the missing middle more viable is that you really have to partner with foundations, so family foundations, because their expertise is community development. And I think pioneering certain structures like blended finance in the Philippines would be really great, right? For them, because you would have people who would who would be buena mano, right? They'd be the first person to invest. Nobody likes being the first, right? Everybody's a little scared, and this is a unique place for foundations and even individuals to play, right? Uniquely here in the Philippines, where 68% of the poor are small scale farmers and fisher folk, we have a law called the Agri-Agra Act, which isn't really being not many banks are compliant with that law, because the banks here are required by that law to loan 25% of their total loanable assets to small scale farmers and fishers. 95% of banks don't, so they pay a penalty. So a penalty is a 0% return scenario, right? So it's not that banks don't want to be compliant. It's not that they're just money grubbing weasels and they don't want to invest. It's that it's very hard for cooperatives and tenant farmers to come up with a business plan that will be eligible. And Shuyan's already mentioned the problems with collateral, right? So you have to localize things to where your ecosystem is, and work with what you have. So the banks really want to be compliant. Also, nobody likes paying a penalty, right? So it's really getting access to the incentives that are already there, popularizing things like catalytic capital and blended finance. Uniquely, also in the Philippines, my last point would be, it would be really great if we could do an OFW bond or a diaspora bond to tap all the Filipino diaspora all over the world, because you know, you have if you can just buy a bond from your couch, which you can with bonds.ph, which is by Union Bank, um, you to help the country and provide a concessional rate of return. I think people would be willing to do that if you could show them a measurable impact, right? And it's the one thing we haven't tried in the Philippines in particular, because South Korea was a backwater after the Korean War. But now we buy our phones from them, and our TVs and our refrigerators, right? So it's because the South Koreans invested in Korea, and the Taiwanese invested in Taiwan, the Indians invested in India, and it's about time we invested in our own country. And I think that's a narrative that needs to be really spearheaded and to be pushed around the world, that it's not so much that it's time to give back, but there's such an opportunity, and there's so many undervalued assets in the country. And this is something that everybody should be promoting, not just the government, but foundations and investors like us, right? So it's not so I mean it's not about, oh, sustainability, gosh, that sounds expensive. It's more of like, we should really be pushing the opportunities of sustainable investing as opposed to the costs, right? Because it shouldn't be perceived as a cost, really. So I think that lowering the risk means presenting the fact that to the OMGs and the child of owners, that the right sustainable decision is often the right business decision as well, and it's using existing incentives and new structures like blended finance to and venture debt to provide funding that's more appropriate to companies in the missing middle.
Thanks, Maui. No, that's very interesting and insightful. I think just to touch on two things that you mentioned, um, it's not really part of this discussion, but I think the regulatory framework also has something to do, with really setting that up so that it becomes more investable. I mean, in the case of the banks that you mentioned with the agri-agra law, right? On the one hand, there's that directive or mandate, that law that tells them that they should invest 25%, as you mentioned. But at the same time, BSP, the Bangko Sentral of the Philippines, the central bank, also is really quite conservative and really requires banks to have really very low a portion of the non-performing loans. So if the banks were to take a risk, say 25%, right, and all those loans fail, then that's really going to affect the quality of their portfolio. And so just there's also a mismatch at that level, right? The incentivizing at the regulatory level, as well as a regulatory with vis-a-vis the financial institutions that are supposed to be disbursing these loans or these financial instruments. And the second one around the OFW bond and the diaspora bond, that's kind of the dream, right? We were just talking about this yesterday also with at the CSO fair, where when will we be ready to access the public markets, right? So right now we're all talking about private placements, but the public markets, which really require more rigor in terms of repertorial requirements, maybe that's something we can talk about further. I think that's an interesting topic, maybe for another panel discussion. And I'll pause there, and I go to you, Priya. And if you could also nuance your response to specifically reducing the risk, making the risk more viable, also for women entrepreneurs. We've touched on gender, and Matt also touched on how biases come into play. We tend to invest in business models that we know. We tend to invest in people that look like us. But if, let's say, the people sitting in the investment committee don't have that lived experience of this pain point that this woman entrepreneur is maybe trying to address, say in terms of childcare or maternal health, right? Then it's harder for them to see that. And yeah, would love to hear your thoughts. Same main question, but if you would like to nuance it with the gender perspective, that would be great.
Yeah, absolutely. And, super, everything has been so amazing learning for me as well, just listening to everybody's experiences. And I'm going to take away OMGs and COOs from this conversation
Something
as
new we
well.
learned today. Yeah.
Something new words for us. But, I think for us, I think there are two pieces to our work as the incubator, really kind of building this pipeline, identifying, sourcing, and then working with the entrepreneurs to sort of really help validate their models and get ready for the investments. That's got sort of one lens. And then, of course, through Impact Pioneers, really bringing investors together and then co-investing with them in these early stage deals. But a lot of our work at the incubator level is, we apply a gender lens, and really we have this mission to be a gender smart incubator over the next 3 years. And so strategically, 85% of our portfolio are women led at the incubator level. And because of that, there are a lot of learnings, connected to what Matt was saying. We're also collaborating a lot on this issue. I think what we are seeing is 2 or 3 things which I think are what are being perceived as the risky piece, right? Like one is that, as we all discussed, like the ticket size itself, many of them are not yet where they can absorb 500,000 or $1 million, which is where predominantly, a lot of the capital that is visible is really looking for, and they're not there. They don't actually need that. They can't probably absorb it or even kind of utilize that yet, and will not qualify, with the criteria. But the other 2 or 3 pieces, which I think we touched on earlier on, I think so. One is that it actually is too expensive to do this kind of detailed due diligence on these small deals, and I'll talk about that second. But the other piece is, of course, the readiness itself. So, for example, to give you an example, a company that Greg and I looked at, we were very, very excited about. That we looked at was women led, but when we started, everything looked great, revenues looked great, but then we started looking at, the financials and getting access to like the financial statements and the P&L and some proof of like recorded transactions, etc. It took us 6 months to even just get that information because the entrepreneurs were not yet ready. And so this is when we went straight into kind of the investment side. So on the incubator side, to kind of manage that, we focus a lot on the investment readiness piece, and which is in 2 or 3 parts. And the first is making sure that the women entrepreneurs are able to understand what type of capital they need. I think as illustrated by everybody, is it actually equity investment or is it really more debt? And then who can they access that from? So I think first understanding like what kind of capital and how much do you actually need? Because many times we see 2 things. Either it's a very large ticket size that they're asking for, which you kind of figure out like, do you need all of this now? Or they're asking for too little. Mainly and that's coming from the fact that they probably built their financial models based on either like what's there in their bank account today, or like with some sense of sort of being a little bit risk averse and like how can I really grow this over the next 12 months. So where many times like that means like how much capital they actually need is not really an accurate number. So that's something that we see a lot, and then based on that, what kind of instrument. So that's one piece. On the other side is really actually the financials, and to anything to build a data room that to give either to an investor or to a bank, that is very sparse or it doesn't exist. So many times, whether it's the accountant has all this information and they don't know it themselves, or they have not understood these numbers. So there's a piece around that. And the third one, which I find very predominantly here in the Philippines, is that actually a mindset of whether we should take external capital. I think it's driven by 2 things. I think culturally, like, there is definitely a sense, and I think Shuin referred to this earlier, like, debt is bad, definitely working capital loans. They would prefer to get it from like family or informal lenders even, rather than come to investors or a bank. Of course, like you can't get it, but, or, anything more institutional, and they don't have anything, to access that. But I do see a hesitation, and I think this has been brought on by a very early stage ecosystem where the only news is either like the glamour of people have raised like millions of dollars, but in the entrepreneur circles, it's mostly the bad news and the bad experience of, the villainous investor. So there is a narrative around that. And because of that, the already kind of fear of taking external capital is become a deep-seated fear. And in many cases, like I've been talking to entrepreneurs for 2 years, trying to kind of change their mind to think, actually, you should take this because this will allow you to, grow at the ambition that you have. And some of them I'm still having that conversation after, having worked with them. So I think there is definitely that issue, and it's partly on us as investors as well, because we have not been transparent about the failures and the successes. And I think there is some communication gap that's happening, and there is a lack of understanding because we are very early, in the Philippines, in Southeast Asia itself. How many exits have we had? So we also tend to be a little bit, maybe come across as being, not very transparent. And so nobody knows what's a good term sheet. Like, is this beneficial to me as an entrepreneur? Is it only beneficial to investors? So I think a lot of this deep-seated fear is coming from that. So that's why we focus on fixing these three pieces in the incubation programs. The other piece, which is around the cost of doing due diligence, and so I think it is unfair, given the structures of where funds are, to say, like, you have to come and do like 50 to 100,000 or 200,000. It is expensive. So the way that we are really addressing it with Impact Pioneers Network, for example, is really kind of trying to build that trust among investors, to do this co-investment together. So as Impact Pioneers Network, which is an impact investment platform, really bringing together both individuals and impact investors, this is really what we want to do. We kind of lead the diligence, we share some of those costs of diligence, so we can then co-invest together, absorb a lot of the risk, and then actually invest together at these early stage ticket titles, so that many of them can actually do the next big round. So that's one way that we're managing it. And we have an explicit commitment to fund majority women-led businesses. So we want to kind of make sure that women entrepreneurs know that there is a space. Once they've fixed all these three issues, then there are people out there who want to fund you.
Thanks, Priya. That's I was taking a lot of notes, but a couple of things that I want to highlight. Kind of your last point, right? Also, that who's going to underwrite that risk, and tying in with what Maui was saying, working with NGOs who are working on the ground. We really need to open up, I think, to other players, in the other stakeholders, rather, in the ecosystem. So we talked about government, we talked about NGOs, and even like Impact Pioneers was born through the support of DFAT and USAID. And so really that helps us to underwrite all these expensive things that need to get done, right? And so somebody has to foot the bill. And so, we need to find other supporters around that. And I think what you were saying about the villainous investor, right? There's a lot of mistrust and misunderstanding. And I think, Matt, what you were saying about this whole relationship, right? And building that relationship, we're getting to know them, but they're also getting to know us, and really demystifying this whole idea of impact investment, and that to get them to see that investors are actually on their side, and that when they win, we win as well, right? And so really it's a win-win proposition. And just also around the idea of the landscape and the transparency, it's still really quite opaque, and entrepreneurs don't know who to talk to and where to go, and who is a good match for them. We only have a couple of minutes left, so would just like to round out this discussion. I wish we had more time, but I guess final thoughts from each one of you. Would love to hear, for investors, why should investors explore these alternatives? What's in it for them? You're all doing something pioneering, taking a risk, and underwriting that risk. So this is really more for the larger space of investors who maybe want to, as I said earlier, maybe dip their toes in the water. Maybe they're at the point where they have cold feet at this point. It's interesting to them, but where to start, right? So sorry, that was multiple questions. What's in it for them? How do we get them in? And or if you have time, what would you like to see in terms of more innovation to address this missing middle? So maybe Shuyan, I'll start with you, Priya, Maui, and then I'll go to Matt.
Great. I'll keep it really short because I know we have not much time. But I think one thing that kind of came up for me as everyone was speaking is, so we're talking a lot about risk here in this discussion. And I think no doubt a lot of there is risk, right? There's always risk when investing in anything, almost. Maybe just government bonds, but yeah, basically there's always risk, right? And so how much of these risks that we talk about when we're talking about the missing middle are actual risks versus perceived risks? I think that was an interesting question that we kind of confronted, because especially when, as we've been talking about, I mean, missing middle often seems very monolithic. And then some people, when you say missing middle, people imagine these like tiny businesses with like zero financial records. And of course, like then the risk of investing in those businesses is higher, right? Or I think, again, I think for, as we've again been touching on, there's a very high degree of perceived risk, right, about, say, investing in women entrepreneurs, right? Whereas the reality is that actually, in general, women tend to, at least on say, the debt side, actually tend to, pay back their loans more diligently. And even on the equity side, tend to be more capital efficient, right? So, again, I think it's interesting. I challenge kind of investors. And we did this ourselves, right? To think about, okay, out of all of these different risks, and there's, again, I'm not saying there's no risk. There's definitely kind of challenges and risks to deal with, but which ones actually are real risks, right? That we need to address, and which ones seem to be more just the general, kind of, malaise or bad impression, right, that people have about the missing middle. So I think to me, that's maybe where to begin. Let's be clear about that. And I also think, we've talked about blended finance and catalytic capital. I think they can play a huge role in actually, I guess for some period of time, right? I guess mitigating some of these perceived risks, right? Until different fund managers, different businesses are able to prove out more of a track record, and ultimately, hopefully, because we can't rely on blended finance forever, right? In these structures, but I think they can have a very large role in in this period where I think there's a big gap between the actual risk and the perceived risk, right? Actually helping us at least overcome that hurdle, right? So that would be my kind of final comment. But I think on a positive note, I think there's a lot of great innovation happening in this area, right? So I think that always gives me a lot of hope and optimism.
Yeah, I think we're just getting started. As already mentioned, the ecosystem is still quite young, quite nascent, and it's great to see you blazing the trail in that direction. Thanks, Shuyan. Priya?
Yeah, I'll pick up from exactly what Shane was talking about around the catalytic piece, or using blended financing instruments. I think that's really the key, especially because we sit at the earlier part of that missing middle and trying to bridge this gap to investors who'll come post, $200 or even $500,000. And for us, I think for the medium term or for the short term, we really want to kind of leverage financing structures, leveraging sort of blended finance. So one of the things as Impact Pioneers that we are considering, and thanks to the support of USAID, is a catalytic guarantee fund that can allow us to bring a few different investors together to address sort of at least a working capital loan side. So that is something that we're experimenting with and hoping to launch in Q1 of next year. But I think we've been able to, because of the intentionality of investors coming to the table to address this gap, we've really been able to experiment with very flexible structures. So even though it's very early days and we've only done sort of two deals with that, but everybody is there because they recognize that there is this gap, and everyone is scouting for deals. So we also want to kind of bring those deals to a common place where we can all find it, bring down the cost. And I think catalytic sort of approaches are going to be critical for us to eventually stop talking about this missing middle, really get to the next stage in the ecosystem for us, because I think there is a need for us to leapfrog a little bit. We cannot, it took 20 years, for example, in the Indian ecosystem to get to where it is. I think the learnings and information and experiences are there in this region, in Asia, that we should leverage on to really leapfrog this region, Southeast Asia, which is younger entrant into the impact investing space. So I do believe that these, all of us here on this, but there are many, many others who are experimenting and sharing these learning together faster is the way for us to really make sure that the models that can solve these most urgent climate and social issues especially can get addressed.
Yeah, that loan loss guarantee, I think that's really that's an exciting innovation, and it also helps to crowd in maybe capital that is more risk averse. and help them really make that first step into this space, right? So you mentioned 20 years. It took India 20 years. Maui, you mentioned it took microfinance 40 years. What will make it take us 10 years? So your thoughts around, just the final, this wrap up question around why, and I think one of the things to make it more 10 years, to get us to 10 years, right, is we need more investors to take the risk, that risk capital. And so what's the benefit for them? Why should they get into this space?
Well, I think the thing that would make it impact investing move forward in the next 10 years, which is this is the decade for delivery for the sustainable development goals, no?
Yeah.
Is really you can't really realizing that get you can't get different results with the same finance structures, because people say like, oh, you have a new finance structure, you're doing impact investing, it's all too new for me, you just do one thing that's new. And this is very well intentioned advice, right? In fact, you would give this advice to other people. You can't do three different things that are new, it's so crazy. We don't have the time. We don't have the
Yeah.
time. These are intractable problems, seemingly intractable problems. A lot of this, as Shuyan pointed out, is perceived risk, which you fight with data. And it's also, again, I would say the key also is localization. At Ignite, we're experimenting with a new startup studio model where we farm our own deals, where you don't actually launch the company until we hire them on a consulting basis, so you get paid a decent sort of call center level salary to work on your own business idea. This is a problem in the Philippines because you do need some salary to keep you going. Sometimes you can't pursue your entrepreneurial dreams full time because you're responsible for the education of a sibling and so on and so forth. So we pay them not a cushy but a decent salary, but because you're employed by us on a project basis, that also means that we have more control, because the problem with debt structure sometimes is that you don't have control. You can't prevent mission drift. You can't stop. I mean, you're kind of like a mother-in-law giving advice, which is not a good position to be in for an investor, right? So we
Take
always
it or
say
leave
like,
it.
yeah, we are not your friends. We are on your side, right? But we are not your friends. And this is really important, especially in that phase where we like to invest at Ignite in innovations, business model innovations, and not just technological innovations to help bring people out of poverty. So I think localization, and most importantly, celebrating our successes, because before, I remember in the Philippines, no one knew what a call center was. It seemed dodgy, and now everybody has their call centers all over the place. People are not stupid, right? Once they realize they can make a return doing something, they're going to jump on the bandwagon. So I think it's about time we celebrate our successes as well, here in the Philippines. So, and no matter whose success it is, right? Because I'm equally happy if it's Shuyan's success or Matt's or Priya's, right? Because anything that celebrates the success of the asset class in the world is a good thing.
Absolutely. It moves it forward, right? And I think, yeah, definitely we need to get those stories out there, so that they're not only seeing the failures, which is also as equally important to talk about, because we need that transparency. And we also don't want entrepreneurs to just think it always has to be best foot forward. But definitely the successes are needed so that we can increase the confidence and desirability of the space. Thanks, Maui. And Matt, your final thoughts.
Okay, a lot to follow there again. I think I can share a very quick story which actually touches on some of these points. So when we started, and this is in Myanmar, but we're actually rolling this program now into Cambodia and looking at taking it regionally. So we started as a VC. We're making investments. We didn't do any of that acceleration stuff. But as Maui said about farming your own deals, when all the accelerators left after the political situation here, we saw a need to do that. And we thought, well, if we're going to build something, let's try and build it to the best we can. And let's learn on everything we've done prior. And the outcome of that was a program that has the kind of top of the funnel very automated, so we can have as many people come in as possible at the top. And what we do is we create data. So again, I think both Shuyan and Maui said that with data we can overcome bias, and really integrated that to the program. And so we invite men and women to come into the program. We feature some women in the marketing to encourage women participation. We have pretty equal entrants. But what we see is women are actually availing more of the program than men. And what we're measuring is really effort and engagement. And we see that women are providing more of each of those, possibly because men have different access to these things, typically, through the patriarchy. But whatever, when we get down into the funnel, we go through different stages. Eventually, we get to working with them. We provide them tiny, tiny grants in a very similar structure to what Maui's doing with paying them their startup studio. We start with a few companies with an itsy bitsy grant just to see how they work with it. So they have a bit of money, we can work with them. Then a few less companies. Finally, we get down to 4 and then 2. And that's starting at like 100 or so. And the great news, the first time we did this, the 2 companies that raised money from us and others were both women CEOs. And so immediately we're able to say that even in the environment in Myanmar, 100% of new startups raising funds were women. Now, no market can say that. Wow. And of course, we have to duplicate it and replicate it. But now in Cambodia, we see the same thing. We select 20 companies to go into the kind of middle funnel stage. I think 16 of them are women-led, yet the applications were 50-50. So to investors, and of course, we were only able to do this because we had support from the Sasakau Peace Foundation to come in alongside and really support this program. We actually now see this program can be commercialized, so we're working on that. But I think that we would never have done this, and most VCs would never do this because we're very busy doing what we're paid to do, which is something else. And so it's only through, limitation, these kind of innovations come about. But for people looking at a market, I would just echo what's been said here, right? If you do the same thing, you're not going to change anything. And I think that to those who are funding these programs, spend more time with what looks most different. And just as we challenge the assumptions of others, I think have to do the same to ourselves. So very much echoing what's been said here.
Wonderful. And I think you've done your job for me, my job rather, to, kind of wrap up. And I'd just like to leave this with, from limitations comes opportunities. It's great to hear all the innovations happening in this room. And as much as we want the entrepreneurs to scale their innovations to solve these problems, let's scale these innovations as well across the region and move impact investing forward. Thank you so much, Shuyin, Maui, Priya, Matt. This has been a wonderful and insightful conversation.
Thank you so much, guys. Thank you.
Thank you. It's been a pleasure.